Our fourth team this evening, please welcome University of Johannesburg.
Good evening, ladies and gentlemen, and thank you for the opportunity to be presenting to you here tonight. Our presentation tonight will cover a company overview, an industry overview, financial analysis, our valuation method and models will be discussed, as well as a risk analysis. Tonight, we initiate coverage on SPAR Group with a sell recommendation. Our closing price of R182.50 is met with a one-year target price of R151, providing a 20.85 downside. We have identified the following factors that reinforce our sell recommendation: our stretch valuation, as well as local and foreign saturated market growth and limited organic growth opportunities that Tejo will tell us a bit more about, and Aubrey will delve into our declining margins and explain more about those, which all add up to our sell recommendation. A bit about SPAR. It was established in 1963. In 2004, SPAR Group listed for the first time on the Johannesburg Stock Exchange, and in 2014, it acquired BWG Ireland, which owns the right to SPAR brand in Ireland and could potentially look in going to Switzerland. SPAR has a geographic footprint in Southern Africa that contributes 80% of the group's revenue. SPAR's main source of revenue is distribution base, as it acts as a wholesaler to their voluntary trade partners in this region. Within Ireland, that contributes 20% to the group's revenue, the main focus is convenience retail, in which BWG Ireland occupies 12.5% of the Irish retail market. I will now hand over to Tejo to tell us more on the industry.
Thank you, Dave. SPAR Group operates in a highly competitive South African, Irish, and UK retail environment. In South Africa, a major concern for retailers is the consumer's lack of disposable income, given low economic growth, rising unemployment, and labor unrest. The decline of the rand against major currencies, an anticipated acceleration in food inflation, continued high levels of indebtedness, and rising utility costs all tell us that the economy won't perform any better in the next year. This can be confirmed by the South African Reserve Bank continually cutting the GDP growth forecast. Increased choice, constant innovation, perceived better pricing through aggressive marketing and advertising by competitors has placed SPAR Group in a difficult position. With consumer sentiment expected to remain weak, the fact that SPAR is more expensive than Pick n Pay, Shoprite, and Macro on the lower to middle end, and Woolworths offering better quality products on the higher end, we believe that SPAR is not competitively positioned relative to its peers, and thus not offering any form of value-added proposition, especially to the cash-strapped consumer. The BWG acquisition comes at a time when the Irish and UK retail environment is no different to what we see in South Africa. BWG competes with brands such as Tesco, Sainsbury, Morrisons, Aldi, and Lidl. The German discounters Aldi and Lidl have changed the dynamics of the UK grocery market by offering quality and efficient products and services at discount prices. Research indicates that over 60% of Irish households now shop at these discounters. Due to the current price war taking place in the environment and the change in consumer preferences, we are of the view that SPAR will not realize the margin gains they had hoped for via this acquisition, as this will be further explained by Aubrey in our financial analysis.
Thank you, Tejo. As a result of the BWG acquisition, SPAR's DE ratio increased from 0.04 to 0.84 in the current financial year and is expected to increase even further looking forward. This increase in debt is mainly due to the euro-denominated debt which was imported through the BWG acquisition. The euro-denominated debt consists of a residual payment that is expected to be 96% of expected free cash flow for the year 2019, which makes it highly likely that SPAR would look to refinance this liability. As can be seen by the graph on the left-hand side, SPAR's operating and net profit margin is expected to decline looking forward because of the increases in debt. Current interest expense is currently at 0.28% of earnings, increasing to 9.11% of earnings in the next financial year. The rand value increase is at 350% in the current financial year, increase in interest expenses. The increase in interest expense as well as lower margins of BWG are going to put downward pressure on the operating and net profit margin looking forward. As can be seen by the graph on the left-hand side, our 5-year revenue growth average looking forward for SPAR is much lower than the historical average growth rate for the company. A depreciating rand, as well as other macroeconomic factors mentioned by Tsecho, will force SPAR to reevaluate their dividend policy in order to service debt as well as finance operating activities. I'll now hand over to Ashley to discuss the intricacies and the rationale behind the valuation.
The valuation approach taken encompassed the incorporation of 3 different valuation methods: free cash flow to equity model, supported by an EV/EBITDA multiple approach, and lastly, a relative valuation, all 3 of which reinforce our sell recommendation. The free cash flow to equity model was chosen due to the fact that SPAR Group is asset light, and it allowed us to incorporate core company fundamentals such as those discussed by Aubrey. The model resulted in a target price of 151 Rand, a clear downside even with the anticipated success of the expansion plan. An EV/EBITDA multiple approach was chosen as a supporting model. The model is based on SPAR Group's historical 12-month multiple of 13.9 times. The industry peer multiple is only at 11.8. This, together with current economic and together with the intrinsic value obtained, reinforced our sell recommendation. Lastly, SPAR Group was analyzed relatively with its peers. Locally, it ranked 3rd, whilst internationally it came in 2nd. The analysis suggested that currently Massmart and ShopRite would be better buys within the retail sector, although we would steer clear of the sector in general. A main concern analyzed through one of our sensitivity analyses was the large portion of euro-denominated debt outstanding. As it can be seen in the graph, exchange rate volatility could cause the increase in debt expense to outweigh the increased revenues received from Ireland. Should this happen and South African revenues are needed to compensate where Irish revenues fall short, the group's cash flows will be put under further pressure, and we believe this may even result in the company having to re-evaluate its dividend policy. Although historically SPAR Group has been a stable company, it is currently overpriced, and this, together with economic and industry conditions discussed by Tsecho, will cause the share to derate within the next year. Pamela will now take you through some investment risks.
In understanding the risks that SPAR Group faces, we constructed a matrix that allowed us to see the impact and probability of these risks on the group. As we can see, the rand has depreciated significantly against the euro over 2015, and we have seen this trend continuing into 2016, and we expect to see it continuing going forward. As Ashley has mentioned, SPAR has amassed a large amount of euro-denominated debt, and we believe that this debt will put downward pressure on SPAR's balance sheet as well as their earnings, which we expect to see coming in below consensus for 2016. In South Africa currently, retailers are competing fiercely for retail sites, and with SPAR's voluntary trading model, we believe they will find it difficult to grow organically as opposed to their competitors who own their stores. In the South African market at the moment, we've also seen retail sales coming under significant pressure over the past few years. And although they've been able to remain resilient through 2015, we've seen them come under renewed pressure in 2016, and we expect once again to see this trend continuing given the current macroeconomic situation in the country. SPAR has moved to acquire interests in Europe with the hope of improving those margins. But given the current price war in the region, as well as changing consumer preferences away from the higher margin large format storefronts to the lower margin discounters and convenience stores, we do not see SPAR being able to achieve this margin expansion in our investment horizon. In conclusion, we have a company that is faced with muted margin growth, overexposure to a struggling South African consumer, a highly competitive local and foreign market, as well as limited organic growth opportunities. All this further serves to reinforce our sell recommendation. Thank you, and we will now take questions.